Hi, and thank you for the rare opportunity to attend today this precious webinar. And I would like to thank all the audience who have stayed all the way to the last session of today and to listen to our webinar. We're here to talk about investing into Chinese government bonds and into into our ETF. Now, just let me get the disclaimer out of the way. This is actually done based on our best of our knowledge and for the sake of educational purpose. All investment involve risk, and past performance does not necessarily indicate future performance. So if you please take a look at this ETF and do consult any of the financial advisors whether it's suitable for your investment objective. And having said that, I just want to dive into very quickly, who we are. CSOP Asset Management was first established in 2008 as the first, Chinese asset management company set up in Hong Kong. We are fully regulated and licensed by the Hong Kong Securities and Futures Commission. And having said that, in 2018, fast forward 10 years, we set up office in Singapore. We are fully licensed and fully regulated by, the Singapore MAS. And let me say that as of first quarter in 2021 this year, we're managing a total AUM of $10 billion US. It is a stamp of approval from the investors in all the ETF that we have listed on different multiple exchanges as well. Now, we humbly pride ourselves as a China expert due to our strong Chinese background. And having said that, our majority shareholder is China's Southern Asset Management. They're managing over 1 trillion RMB in terms of assets. They're the top 5 asset management company in China. And having said that, our group shareholder is Huatai Securities. They are into the brokerage business, accounting for 8% brokerage market share in China. And number one, therefore, hence they are number one in terms of brokerage business in China. And having said that, these two major shareholders are actually feeding us, live information of what's happening in Hong Kong and in China as well. And we're actually, passing these resources and this information down to the investors here in Singapore and regionally. And having said that, we humbly pride ourselves as an ETF leader. We won multiple awards last year. As one of it was actually the ETF Manager of the Year, awarded by Asia Asset Management, both in Hong Kong and Asia. Now, the ETF that we're going to talk about today is the ICBC CSOP FTSE Chinese Government Bond Index ETF. Now, it has been awarded as the most innovative product last year. So we're here to discuss more in details of what's the ETF. And having said that, what I'm going to talk about and why we're here today. We're going to talk about China and the renminbi outlook, from recovery to growth, the story. And, we're going to talk about the Chinese government bonds. It's offering very attractive yield and of course, providing very strong credit quality ratings as well. And we're going to talk about, the index. Every ETF tracks an index. We're going to talk about the FTSE World Government Bond Index as well. You're going to be expected to add Chinese government bonds into the ETFs, into the index, and how we expect, more inflow into this index and to this ETF as well. Last but not least, you have access into trade to onshore Chinese government bonds. After I state about the benefits of Chinese government bonds, you could use the ETF listed on SGX, and how you can actually provide you with easy access and liquidity and reduce the cost into these benefits. So all this will take about 30 minutes. You were able to understand, the benefits of Chinese government bonds. You understand what the Chinese government bond markets are, and why this ETF can provide an easy access to you. So having said that, by the end of these 30 minutes, you were able to trade and invest more confidently into the onshore Chinese government bonds via our ETF. And having said that, China is actually, let's take a look at China. It has actually been a recovery story for last year. And for this year, he has actually gone into a growth story. Right now, we believe that China is actually into a sustained and more moderate and stable growth going for the second half of this year. And having said that, the June manufacturing PMI does inch a bit lower. It came in at 50.9 in June versus May 51. That is actually due to some of the COVID outbreaks within the region in China. The non-manufacturing part recovery has actually recovered much faster for the non-manufacturing part. The PMI came in at 53.2 versus May was actually 55.2. That is actually dropped after because of there is a outbreak of a new fresh a case of COVID-19 within China itself. And having said that, we look at the numbers for export and import. And having said that, having said that, when we look at the May numbers, right? May export has actually softened to 27.9 year-on-year versus April, which is actually versus April, which is 2.3. That's actually because regionally we are actually facing a new bout of COVID Delta variant, right? In terms of that, and export has been slowed for a while. Internally as well, like I did mention in the previous slide, we are actually facing some form of COVID-19 within China. That's actually hampering some of the supply chain within the onshore market. Now, import, however, has actually accelerated its growth 51% was year-on-year based on the low growth and based on the higher commodity price as well. That's because usually whenever China has to export, they will definitely import more raw materials and then manufacture them onshore, and then we export them up to as exports and product as well. So having said that, export stands out because of China actually won bigger global market shares just last year alone. With the strict and the swift response to the COVID-19 last year, they are able to get their workforce back into the market, back into the factories, and get them up and running again. So having said that, in terms of the export, China actually won 2% in terms of market share in terms of export versus the rest of the world. Now, last year, during the peak of the pandemic, right? Last year alone, they have actually created trade surplus of $535 billion. That is during when the pandemic is actually at its highest. As of May, just the trade surplus came in, they edged up a bit higher at $45.5 billion. So financially, China is actually doing pretty well. They're actually creating trade surplus year on year, even though we are facing a pandemic. On the flip side, China is talking about wanting to boost domestic consumption, and to boost domestic consumption, they need to address the employment situation. Now, in February last year, right, at the peak of the pandemic, the unemployment rate was actually at 6.2, and that has actually due to multiple policies imposed by Chinese government, that unemployment numbers has been coming down a lot already. And of May, the unemployment rates actually stand at 5, and this is actually a good job done by the Chinese government to continue to manage the unemployment rate. And having said that, from the year to date right now, they have generated about 5.7 million new jobs in cities and in towns across the world, across the country, and that's actually a very positive sign. That's actually providing a tailwind to push out the domestic consumption targets that China has implemented within their 14th five-year plan. So what is the rest of the outlook for China, right? Just taking a step back, last year in 2020, we forecast, OECD forecast that China will eke out a GDP of 1.8. They came in at 2.3. They beat expectations, and with that, the start of the year, UBS and the World Bank, forecast that within this year, Chinese government will eke out a GDP of about near to 8%. Now, just this last month alone in June, they actually revised their GDP growth forecast, and they're actually very optimistic with China in terms of how they have responded. So the UBS and both the World Bank actually revised upwards the GDP forecast for China to about 8 to 8.5% respectively. And having said that, why we believe that this is actually an achievable target, because they're going to boost up domestic consumption, and we believe that retail sales will definitely bump up from last year, from the pandemic. This is due to the growing middle class, in terms of wealth, accumulated savings that are actually being pent up, the lack of travel globally. Chinese right now has actually accumulated a huge amount of savings right now. And having said that, we believe that retail sales will actually, which account for 40% of the GDP numbers, would actually drive that numbers to be an achievable target. And having said that, when we talk about retail sales, we talk about the countries are importing a lot more, and we could see the main numbers actually come in very high versus the export. So having said that, just what our CSOP views about the renminbi outlook, right? Since the high of May last year, it actually gained 10% versus US dollars. That's because China is actually first in, first out, and they were first to recover from the pandemic, and they actually get their engines running and getting their factories up and running as well. And due to that reason, the renminbi has actually appreciated and has been in favor for the last few months and years. Last few months, last year, 1 year, right? Last 1 year, renminbi has been very attractive. Now, having said that, US economy is actually catching up. The numbers are coming down in terms of COVID infection, and you could see that even though renminbi has actually weakened about 1% versus the USD, that's the main reason that USD is just US economy is just playing catching up, and you could see there's a giving up some of the gains or appreciation of renminbi versus the US dollars. But having said that, the renminbi is actually up about 3% versus the basket of currencies year to date already. So again, this is actually based on why Chinese government bonds has been pretty attractive. Is because of the yield differences between the 10-year of US 10-year treasuries versus the China's 10-year right now. And having said that, as of end of June right now, the Chinese government 10-year Chinese government bond yield is about 3%, which is actually one of the highest in terms of the Chinese in terms of government bonds around the world. But having said that, recently, with the triple R cuts, the previous speaker has mentioned, that has actually broke. That has actually bring down the yield for both US treasuries and Chinese treasuries as well. However, the difference of 1.78% in terms of yield between the two countries puts Chinese government bonds in a very attractive position. So having said that, let us talk about what is Chinese government bonds, and why is it so attractive? Because it provides very attractive yield and also very strong credit rating. Right now, amid very low growth situation environment right now, it's very, very difficult to search for a very decent yield. And having said that, the Chinese government bonds, does offer a very high, yield comparing to other government bonds as well. So the high yield, the 10-year government bonds yield about 3.1%, and this is actually very high quality of A+, and they're all trackable history. There's actually no history of defaulting. And being said, being rated at China of credit rating of A+, that is actually very similar, the same credit standing as the Japanese market, and even higher than the Italian government bonds, which stands at BBB. So again, Chinese government bonds, offering a very attractive yield, over 3%, yet very strong credit rating, very similar to Japanese government, and has no trackable, default in a trackable history. So having said that, how when you put Chinese government bonds comparing to the bonds in most of the developed markets bonds, is that when we talk about yield to maturity, is actually one of the highest when you're comparing to the 10-year US Treasury, the EU and the UK gilts, and of course the Japanese bonds as well. It's actually the highest among all the developed markets. Now, when you talk about duration risk for holding the Chinese government bonds, is in fact actually the shortest duration risk when you put it up against US, Japan, UK, and the EU zones, right? And in terms of annualized return, it's actually one of the highest again among the 4 countries. And when you talk about the volatility, it's actually coming into second versus the EU zones, the UK gilts, and the Japanese government bonds. This is actually based on a simple fact that volatility is not within the price itself, but actually within, if you will convert the renminbi to US dollars, that is actually the inherent currency volatility. But having said that, the price of the Chinese government bonds has been very stable. It's actually been very stable since the start of the pandemic, and that is the reason why the volatility is actually much, much lower than the Japanese government bonds and the UK gilts as well. If you put such, the return and the risk ratio, if you were to divide it, it's actually very strong at coming in near to 1. It's actually one of the highest risk return ratio if you compare it to Japanese bonds, UK gilts. It's actually one of the highest, in fact, the highest among the developed market developed market bonds. So having said that, having a strong risk return profile, what about the co-relationship? What does Chinese government bonds does to portfolio of government bonds, right? And having said that, it has a very, very low co-relationship with the major government bonds. And having said that, it provides a very strong diversification tools if you're holding a basket of bonds itself. So having said that, why Chinese government bonds? Because the Chinese bonds market is actually the second largest bond market globally. And having said that, they have outstanding, the market value is about US $16 trillion as of May this year. It's actually second to US market. Now, however, the foreign holdings for Chinese government onshore bonds is only about 3.5%. It's actually the lowest among major markets. Hence, we CSOP believe that there's actually future performance potential for huge inflows into this asset class and into this country segment. And when talk about issuance of government bonds, China is still in terms of the debt to the GDP is still pretty low comparing to US, UK, and even Japanese bonds. They are actually borrowing within their means. There is no chance of over borrowing for the country itself. So we believe that with such benefits and not over borrowing in the market, we believe that they are actually a very attractive piece that you should actually look at as well. So the main drivers for Chinese government bond investments is actually because of the renminbi resilience, a very high coupon and very strong credit rating. And these are three reasons. It's going to be basically why it will continue to support onshore Chinese government bonds in the future. So what are our views of the Chinese government bond markets going forward? We break it down into three elements in terms of price returns, in terms of coupon returns, and in terms of the FX returns as well. So in the short term, we believe that the price return has been very neutral because of renminbi have actually appreciated really, really quickly just last year, and believe that this year they will take a neutral stance going forward in the short term. But in long term, we are still very positive of how international will be recognizing renminbi as one of the major currency players. So in the long term, you will have a positive, positive view of the price return in terms of renminbi. Now, in terms of coupon, because of the strong yield that they are offering, both short-term and long-term, we are very positive in terms of the attractiveness of the coupon returns. And having said that, the FX returns, we are very neutral and we are very positive going forward. So these are three major criteria that will definitely be the main drivers for Chinese government bonds investment going forward. So having said that, right now, year to date, CNY has already provided about 2% return, and in terms of price, in terms of the FX contribution, about 1.24% is actually due to the FX returns. And all in all, total, in terms of when we talk about the US returns, it's actually Chinese government bonds actually eke out over 3% returns for Chinese government bonds already. So having said that, when we talk about bond indices, right? There are three major indices that bond indices that institutions look at. We look at the Barclays aggregate bond index. We look at the JP Morgan global diversified emerging market bonds market as well. So they really have decided to include Chinese government bonds into their portfolio. And having said that, the FTSE Russell has also confirmed they will include Chinese government bonds into their FTSE World Government Bond Index starting from October this year. Now, why this is very important? Because that would actually attract new institutional monies into the Chinese government bonds. And having said that, that would definitely show up and provide liquidity for the underlying of the Chinese government bond price. So having said that, right now foreign institutions are only holding about $2 trillion worth of Chinese government bonds as of March this year. They are actually the second largest market player with over 10% market share already. And having said that, with that inclusion into the world FTSE World Government Bond Index, more institutional monies will definitely flow into, and we expect about 150 billion new money will be flowing into the Chinese government bonds itself. So here we are going to talk about the ETF. Will provide you access, liquidity, and cost. Now, having said that, we have listed our ICBC CSOP Chinese Government Bond ETF on SGX in September last year. It is an EIP product, so that means normal retail investors can invest easily on the SGX stock exchange. So far, this ETF, due to the benefits of the attractiveness of the onshore Chinese government bonds, it has actually become the world's largest ETF that tracks purely on Chinese government bonds. We are actually managing over US $1.5 billion in terms of assets under management. And we see that most of these seedings are actually coming from sovereign wealth funds, endowments, family offices, national banks, and large Singapore institutions. And having said that, the board lot size is actually very small. It's only about 10 shares. We do give out dividends semi-annually, given in June and in July and in December as well. So the total expense ratio is actually at 0.25%. It's a very low total expense ratio for provide any investors into access into onshore Chinese government bonds. So having said that, let's compare the institutions, the index versus the ETF itself. So right now we have the inception date is actually listed on September itself. In terms of bonds, we are actually mirroring the holdings itself. And right now the duration risk is actually very, very short. Not only the ETF itself is actually strong credit rating, the underlying bonds itself, each and every bond is actually credited at A1 and A+. So having said that, every underlying bonds is actually of investment grade and have a very strong credit rating. So having said that, why this ETF? This ETF provide an easy access to onshore Chinese government bonds. So normal retail investors could not, have easy access to onshore Chinese bond market directly. Even for institution, right? They have to set up, you have to set up an application with the onshore PBOC. They have to manage account. You have to manage hundreds and hundreds of positions. Now the institution likes our ETF because it's a very, very easy investment tool via ETF. They actually have a single, you get achieve diversification in a single trade, right? You're able to see that, some of the bonds may not have actually a bid and ask spread, right? But yet our ETF continue provide, constant bid and ask spread on an intraday. It actually provide a very higher transparency of how we get in and out. And so that's the reason why, the institutions like the ETF, and we're offering this to the retail investors as well, or via EIP product. And also not only being providing an easy access to the retail investors, you also provide a very efficient in terms of capital efficiency, in terms of cost as well. Now this ETF offers a very transparent total expense ratio of 25 basis points. And if you imagine there's only one transaction required, and then buying into the ETF allows you to have access and exposure to the underlying 50 onshore Chinese government bonds really. Now, if you were to buy the individual bonds itself, it's going to cost you, 50 times the transactional cost as well. So it's so much easier in terms of cost, in terms of capital, to just invest via ETF with one single trade. So having said that, we have actually talked about some of the benefits of Chinese government bonds really. Now let's do some form of back testing. If you would do a 5-year regular savings plan onto the Chinese government bonds ETF, right? If you put in every month you put in $100 since 1st of July in 2016, and then you were to withdraw just June this year, that's actually a 60 months holding period. And we said that you have actually deposited $6,000 for these 60 months, and then by the end of the period you'll get back a total excess, including of dividends as well, of 6,796. Now the cumulative returns comes in at over 13%. And let me say that, and I just want to put a disclaimer here. Past performance does not indicate future performance. But having said that, these annualized returns over 60 months, right, will come in at 2.5%. This is actually a much higher versus right now in very low yield environment. So this annualized return seems pretty okay. So having said that, what about if you are already having an investment into a pot of Singapore REITs already? How would adding a bit of Chinese government bonds to your portfolio, how would it done? How would it benefit your portfolio? And having said that, we will look at, we just did some form of testing, and we found that, the Chinese government bonds has a very negative correlationship versus Singapore REITs. And having said that, that's provide a very strong diversification to your portfolio. And we believe that, by adding about, if you were to hold 100% in terms of Singapore REITs, you're facing a 10-year annualized volatility of over 13%, and your annualized returns comes in about 9.4%. That risk return ratio is about 0.71. But if we were to tweak it a bit by rebalancing, and we found that if you add 10%, 40%, or 7% of Chinese government bond into your portfolio of REITs, we found that the most optimum range is actually if you're holding 30% REITs and 70% Chinese government bonds. Now, how we do is actually it would, even though it would actually bring down the annualized return by a good 3%. However, we are able to bring the volatility of the whole portfolio by a good 10%. So what it does is actually it reduces the volatility of your portfolio, yet without sacrificing much of your annualized return. So having said that, that doubled your risk return ratio from 0.71 to 1.4 ratio. And having said that, how about if you were to, if you're actually holding a portfolio of Singapore stocks already, and how would, by adding a bit of Chinese government bonds help you in your portfolio? And we found that over a 10-year, 10-year history, we found that, it has a negative correlation with the Singapore stocks or Singapore portfolio. And let me say that, if you're holding 100% STI, right, you're experiencing about 14.5% in terms of annualized volatility, and you are only getting about 4% in terms of returns ratio, and that boosts your annualized risk return ratio about 0.25. Now we realize that if you were holding a 20% Singapore stocks and 80% Chinese government bonds, that boosts your risk return ratio to 1. That actually reduce your annualized volatility by a good 10%, yet boost your annualized return by a 2% return. So again, Chinese government bonds, by adding a portfolio of stocks, helps you to diversify your portfolio. It also reduce your Singapore portfolio and have a bit of a boost in terms of your annualized returns over the 10-year period. This is actually due to a very strong coupons, regular coupons payout by Chinese government bonds. And that's the reason why it helps the Singapore portfolio as well. Now, if you're a seasoned investors and actually invest into US stocks right now, and how it pans out with the US stocks, with the US and China trade tension. Now, if you were to, we found that again over a 10-year history, we have actually very low correlation with US stocks as well. And if you're holding 100% of US stocks over a 10-year period, you're actually exposing yourself to annualized volatility of, again, about more than 13%, and with annualized return of about 15%. And having said that, that's give you a risk return ratio of 1.1. Now, if you were to put in about 7% of a portfolio into Chinese government bonds, we found that optimally, if you put 7% of Chinese government bonds into a portfolio, it brings down the volatility by 3 times to a portfolio, and that improves your risk return ratio from 1.1 to 1.36. So having said that, I actually reached the end of my webinar. Chinese government bonds, or just some of the key takeaways, is that Chinese government bonds provide a very strong, attractive yield versus other government bonds that's offering there. Actually, a very strong credit rating of A+, very easy access into onshore Chinese government bonds by using the ETF listed on SGX. And let me say that we look at the correlation, be it with other government bonds or with equities, it actually have very low correlation. In fact, against Singapore REITs and Singapore stocks, it has a very low correlation and negative correlation as well. So hence, it actually provides a very good diversification benefits, and yet reduce the portfolio volatility as well. So having said that, I'll actually hand the floor back for any Q&A. So there's one question from Mr. Eric Lee is that, is the bond distribution taxable? No. For Chinese government bonds, the Chinese government has said that, they will not tax the coupons indefinitely, right? So the bonds coupons are not taxable. Then what's the name of the ETF? The name of the ETF is ICBC CSOP FTSE Chinese Government Bond Index ETF. So ICBC CSOP CGB ETF volume is a bit low, yes, because it's actually a income that. So it's a fixed income. It's actually most of the time investors will just come in and invest and hold really, really long term. In terms of the volume, is a bit low. We have actually multiple streams of actually executing into the trades. Most of the time, if you have any issues, if you believe that if you have any issues of getting into the ETF, don't hesitate to reach out to Phillip, and Phillip is actually one of our liquidity provider as well. They will actually manage the liquidity needs that you have if you are having a trade, a huge volume size as well. So there's a question from Jack Young. Can we buy it in podiums? Yes, you definitely can do it. There are there's two classes, different classes, currency classes that is actually being listed on the stock exchange. Sorry, on the US stock exchange, on the SGX. There is the Sing dollars and the US dollars class that is actually listed on SGX. Now both different classes are fungible. That means you could actually buy. If you have actually some US dollars and you want to buy into the US class, and if you have future needs in terms of Sing dollars, you can actually liquidate it using the Sing class as well. So both are fungible. In your CDP statement or within the holdings statement, you can see you have let's say 10,000 units of CGB ETF, but you can actually you could have bought it in Sing dollars and sold it in US dollars, vice versa. So both currencies, they are fungible. Okay, so there's this question by Mr. Kevin Lau, is that yes, they do give dividend. The frequency is semi-annually. We will give out in both in June and in December as well. So the frequency is semi-annually. Yeah, this is the semi-annually, yes. So there's one Jesse Ong. Is it traded in Sing dollars? Yes, there is both traded in Sing dollars and in US tranche. So Mr. Fabian Xiao did ask, can you explain how the US tranche work in terms of FX and other mechanics? So the underlying base currency for this ETF is renminbi, because it's actually the asset class is actually onshore Chinese government bonds. And let me say that if renminbi were to strengthen against Sing dollars, right, then the Sing dollars class would definitely goes up as well. That is actually barring that the underlying of the individual bonds are staying flat or staying stable. The price of Sing dollars will definitely go up if the renminbi appreciate as well. Likewise, if Sing dollars were to strengthen against renminbi, barring the underlying coupons, underlying bonds are remain stable, then the price would go down as well. This is actually how the FX will work in terms of the market price on the SGX that you see. So by question by SC, what is the minimum lot size? The minimum lot size is 10 share. So that is actually about, right now it's about 13, if you're talking about the Sing dollars, or the Sing dollars class is about $14.28. So buying 10 shares will only cost you, with the easy access to onshore Chinese government, will cost you about $142.80 before commission. So by SHU, who else makes the market? So we have engaged 3 market makers to provide liquidity on the stock exchange. They are Phillip themselves, they are actually our market makers, flow traders, and another market makers as well. So there is a question by Liu Poi Hun, right, saying that, sorry about that. The price has gone up, from 13.58 to 14.28, right? This means that the return is lower. Now the return, when you talk about return, we're talking about the price return, definitely, the price effect provide in terms of capital appreciation. But having said that, in terms of the coupon, the flat yield, we call it, dividend yield, where you talk about stocks, getting dividends versus stock price, we call it dividend yield. But in terms of bonds, we're taking the coupons returns versus divided by the entry market price right now. The flat yield is actually about 3.05%. So even though the price has appreciated a lot, the yield has actually gone up. The yield has actually stayed very stable at above 3%, as even though the price has actually appreciated. This is actually because of the strength of the coupon offered by the Chinese government bonds. So this question by Vincent, dividend payout is renminbi. The dividend payout is actually in US dollars. So what is the stock code? Sorry, what is the SGX stock code for this ETF? The stock code of ETF, let me just type it in, CYC, that is actually for our SGD class, and CYB, that's actually our USD class. So there's a question from Miss Elaine, can we use CPF? Unfortunately, right now, we are still putting up requests for CPF board to approve. Right now, only SRS and cash is actually approved to invest into our Chinese government bonds ETF. So there's a question by Mr. Gordon Chong, is the fund hedged again Sing dollars? No, we are going with most of this ETF is actually unhedged against renminbi. Now, we believe that because of our view in terms of renminbi, has actually helped the appreciation in terms of the price of the ETF. And it's actually we believe that by hedging, and in terms of hedging costs against renminbi, will ease up the returns of the ETF. We definitely did not want to adopt a hedging renminbi hedge ETF. So again, Mr. Eric Lee did ask a question, what is the total expense ratio of this ETF? the total expense ratio of this ETF is actually 0.25% annually. So by Michael Robinson asked a question, is the dividend of the CSOP bond paid in cash or more shares? It would be given out in cash in US dollars. Investors whether have a choice, we do not right now, we do not have a choice right now, but definitely we are working with the exchange to provide the investors more options to receive their dividends, whether it be in more shares or in different form of cash as well. They definitely could actually reach out to SGX and say that, hey, I want to receive it in Sing dollars as well. They will automatically do a conversion as well. Again, there's a question by Mr. Wiki Wong. Is the mandate restricted to Chinese government bonds? Yes, because we're tracking an index that's actually purely tracking the performance of a basket of Chinese government bonds only. That's the reason why we are only tracking, the full short-term and long duration Chinese government bonds. I could not, I could not include, other forms of Chinese bonds within this ETF, even if the yield are higher. So will we be taxed for getting this ETF? No, there is no tax. We already, on the coupon side, we are the Chinese governments are actually not taxing the coupons already. And on our side here, Singapore investors, we do not get taxed as well for these coupons. Okay, just to answer Mr. Clifford Low, the Chinese government bond is renminbi denominated. The base currency is actually renminbi denominated, but we actually convert it into US dollars class and Sing dollars class, and it's being tradable on SGX. So to answer Mr. KMR said, what's the current yield right now? Based on the price of the current price right now, based on the coupons we expect to receive, the current yield is actually about 3.05 based on yesterday's closing. My holdings for within the ETF spans out to short-term and long-term duration bonds as well. And I would like to go back to that slide to show you the breakdown of. So you can see that we do hold 1 to 3 years, 3 to 5 years and mid-term and long-term duration bonds based on the index as well. So we hold a full range of duration in terms of Chinese government bonds. So Mr. Eric Lee did say that those who bought into the Sing dollars class will also receive in US dollars. That is correct. We are working out to actually allow other investors to receive other currencies. But right now, if you invest both in US dollars or the Sing dollars tranche, you would receive in US dollars. Okay, I think we have reached the end of the webinar. I will hand the floor back to podiums and to let them conclude today's webinar.